Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend, all. Ira Epstein of Linn Associates with your agriculture update for this weekend edition. And this is Friday, the 11th of January, 2019. Now, remember on the weekend, we'll take a look first at a monthly chart, and then everything else will be on the weekly charts that we look at. I'll be showing a few different things than I showed during the week, like Fibonacci numbers. But the important thing to remember is that we still have the government shutdown. We're not getting the right amount of information that we normally get from the government concerning government supply, demand reports, and so on in the grain market. So these are things to think about. In the meat market, keep in the back of your mind that China still has swine flu issues. We're seeing them use a lot less soy meal than they did before, because when you get that, people just stop eating pork. Do you remember mad cow disease in the U.S.? Same thing. So for the week, it's an up week, not a dramatic one, but it is an up week. Beans up 3.5, wheat up 5 3/4, and the corn up about 2 cents, down a fraction in the cocoa market. As we take a look at the monthly area chart of closes, the bias will remain down as long as the market stays underneath the 18-week moving average of closes, and you can see where that's at right through here. So general downside bias. Now, this is a weekly bar chart with a Fibonacci study. And the high of the market was made back here at 1071, and we can come back and you can see that last year, a year ago at this time, that's where prices were. Then we got into the trade fiasco with China, as you know. Prices fell from there approximately $2.60. So you go from the high to the low, and the famous, I think it was Italian mathematician Fibonacci, he came up with the idea that markets go into reactions from highs to lows or lows to highs, and they go in the range of 38%, 50%, and 62%. You can even go further than that. I don't own the patent on that. You can go as much as you want. But here's how I teach with it. When you get into the first box, and this is what I call that box area from the low to the high, that's a resistance point. You'll hear people say a 50% retracement. Then you hit the next box area. You're stalling out in this box area. That's the important thing to understand. When you look at what the market's done with a swing line study, this shows that the pattern has been one of higher lows and higher highs. I define that as bullish. In order to break the pattern, the market would have to come down and take out the low right here, and if you can see where this low comes in at 867. So that would be the number that currently would break the pattern. Going up just keeps the pattern going. When you look to see where support is, if you're a moving average theorist like I am, I look at key moving averages. Now, some people use an 18-week moving average. Some use 19, 20, 21. I'll let you do your own thing. Years ago, I used to buy services that would optimize them. I found them not to be worth the time and effort. So I use the 18-week moving average, and my theory is that when the market's over it, if it falls back, support could come in against that number. Now, you can swing around it, but it gives you the general idea. And even back here, you kept the pattern of higher lows, higher highs. Resistance. You can see the 100-day average of closes. Now, some trader could put a 50 on it, a 100, 200. It's whatever your heart desires. But one of the things that traders do look at, that I find at least, are where do the Bollinger Bands fall in? Now, Bollinger Bands are this algorithm you see right here. There can be other services you use instead of Bollinger Bands, I should say technical studies, that maybe will do the same thing. I like these. They're simple to understand, simple to work with. Simply put, when a market's at the 18-day average, one of the goals is the closest of a key moving average if it's above the market or a Bollinger Band. I even use window envelopes in my course. And right now that number comes in here at the 925 level. As you can see, momentum in the market has flattened out, which goes hand in hand with the market getting up now. And if you'll notice, for the past couple weeks, we haven't really gone anywhere. You got up into the 930 area here, but you backed off and just sort of hung around, not going anywhere. In the meal market, notice how thin the Bollinger Bands have gotten. They have narrowed themselves in all the way down to right here. It is from this type of action that, generally speaking, big moves come. And the reason is, think of this as a funnel of energy. It's priceless, I realize it. But then they all start going sideways, and then they start compressing on themselves. At this point, I have a bullish bias. I see the market has higher lows, higher highs. It paid attention to the upper Bollinger Band, and now the market's pulling back for support, as I often say, at that 18-week moving average. As long as prices don't close under the lower band, this is no more than a pullback after the first test to see what was above the market, how much resistance. Soybean oil has a different pattern than the other. I can argue that you've got lower highs and at the same time higher lows. So the market's narrowing itself in like that, and you can see that the sideways action, how it's developed in the Bollinger Bands. But unlike the meal, which has the higher lows, higher highs, this is missing that component. If it takes out right through here, and that's 2 weeks ago's low, and that low in the market was 27.27, well, that could set the pattern off to lower highs, lower lows, but you're right against the lower Bollinger Band. If you keep things going and take out this high, you'll have the higher lows, higher highs, but right into the upper band. Either way I go about it, I think you're caught between those bands for a bit. In the corn market, momentum has been up. The market confirmed a week ago higher lows, higher highs. The overall trend is up. So you'd have to take out this break low right here of 372.5 in order to break the pattern that you've got. Now let's assume that occurs, even though the bulls have control right now. Then you come back into support at the 18 and the 100-week average. That's not to say you can't slice through it, but my point would be it's easier if you do that to say you're into support than it is, well, we're just going to fall apart. We'll have to see what happens. The bulls have control of the market. Momentum has been up, but you can see for the last 2 weeks you've sort of run out of a reason to push the market higher. At the end of January, the Chinese trade delegation, the more senior level members, are coming into the United States for the next level of meetings on everything. And at that point, we'll get back Mr. Lighthouser into it, Treasury Secretary Mnuchin. So it's all the bigwigs coming back. Will grain play a part in is what people are asking. And of course, grain's been hurt because what about funding for the farmers that have been at the front end of all this with these trade, if you will, wars going on? And now I understand that the government funding has put an end for the moment to them getting further funding. In the wheat market, you've had the pattern of higher lows, higher highs. Therefore, the longer-term chart, the weekly chart, is bullish. You'd have to take out right through here this number, and we can go back to that for you, last week's low, 501.25, to get the market out of this bullish pattern. Momentum, though, is flat. Bias is up. If the market lifts its head, look for the upper Bollinger Band to be one of the areas of resistance. And as you can see in cocoa, that resistance now 3 weeks in a row at the upper Bollinger Band. We have a story of sideways action overall, momentum flattening out. The trend is up. Support on breaks back between the 18-week average in red and the 100-week. In the sugar market, battleground right now, the 18-week average. Look at how many weeks. You've got about a month here of the market trying to break out to the downside, to the upside, but it's all against this average, not really going anywhere. The market has a pattern of lower highs and lower lows, but the close at 1278 is over 1250, so you have upside bias. Downward momentum, upside bias, and a swing line down, I'll call it confused. In the coffee, while the daily charts have broken out to the upside, the weekly charts have rallied back up to an important 18-week moving average to decide what next. Now at the close Right now we finished at 103.85, and if you look here, 106 and a fraction, 80s is where the resistance is. So you haven't yet been able to clear on the weekly chart and say, okay, something good is happening. Nothing more that I can say than that. You have the swing line up, and even if it broke through these lows, the pattern would then be a higher high, lower low. There's a better chance to march to the upside than downside, but you've got to first clear that hurdle. In the cotton market, you've gone from a higher high pattern to a lower low, spent a month going back and forth against the lower Bollinger Band and trying to get a bounce away from that at this point. Resistance pretty solid between the 18-week average and the 100 on these rallies, and support at the lower Bollinger Band. I'd say that the downside momentum came out of the market, but it didn't turn bullish at this point. The cattle market's been a bull market. You've had the higher lows, the higher highs. You get up to the upper Bollinger Band, you back away, and you keep going there. In addition, you had a bullish crossover, which means that the shorter term average, the 18-week, has now crossed the 100, and momentum is staying bullish. Bull market as I define it. In the hog market, momentum's still up. The bias up is you're over the 18-week average, and the trend up. Now, if you'd close under the 18-week average, you could reverse that. You're not doing it yet. So the bulls still have control of this market as well, at least as I see it. You know, I talk about this, the way that you're seeing me do it, and a heck of a lot more in my twice daily commentaries. Starting Sunday night, I write a commentary and typically publish my audio commentary with it. From there, on Monday, Tuesdays, Wednesdays, and Thursdays, at least 2 commentaries a day, sometimes special ones, special reports that I put out for the clients. If you haven't tried my research, why not give yourself a free trial to it now? Either call my staff, go to our website and sign up for it, or click here. Better yet, if you've tried it, why not put it to advantage for you? Become a subscriber. Either way, I'm Ira Epstein. You have a good day, and I'll see you all Monday.